The U.S. is poised for a major shift in monetary policy. After months of debate, the Federal Reserve is expected to cut interest rates on Wednesday. This will be the first rate cut since December 2024, lowering borrowing costs across the country. But this decision carries deeper implications for the economy and politics. The Fed is expected to reduce its key lending rate by 0.25 percentage points, setting it in the range of 4% to 4.25%, the lowest since late 2022. This cut is designed to stimulate the economy by making loans cheaper for businesses and consumers. But rate cuts are also a warning sign. They signal that the Fed is concerned about slowing economic growth, particularly the labor market. Split screen showing a worker, a small business, and a family applying for loans. Why now? Inflation, which spiked after the pandemic, has slowed, though prices rose 2.9% over the last year, still above the Fed's 2% target. Meanwhile, the U.S. labor market shows weakness. Job growth has slowed, and June even saw a decline in employment, the first since 2020. It really comes down to what we've seen in the jobs market, says Sarah House, senior economist at Wells Fargo. The Fed wants to ensure the economy isn't overbraked while the labor market is already softening. The rate cut comes amid intense political pressure. President Trump has publicly criticized Fed Chairman Jerome Powell, calling him a real dummy for leaving rates too high. Trump has even pushed for rates as low as 1%, claiming the Fed is holding back the economy. He also recently appointed Stephen Moran to the Fed board and has threatened investigations into board members, moves critics call an unprecedented attack on Fed independence. Overlay of Trump's social media posts with bold text highlighting phrases like "must cut interest rates now." Despite the political noise, analysts say the Fed's decision is likely driven by economic realities, not Trump's pressure. The president's jawboning of the Fed to lower rates, I think, has had zero impact whatsoever, says Art Hogan, chief market strategist at B. Riley Wealth. Markets, however, are closely watching. Lower rates generally boost stock prices and housing markets, but they also signal potential weakness in the economy. Fed officials in meetings. The Fed is not alone. Central banks around the world have already lowered rates in response to slowing growth. In Europe, the UK, and Canada, borrowing costs have fallen, supporting business investment and consumer spending. For the US, the Fed's move aligns with a global trend of easing monetary policy. Lower interest rates mean cheaper loans and mortgages. For families, that can make homes more affordable. For businesses, it can support expansion and hiring. But there's a catch. Rate cuts are often a response to slower growth, and they don't fix deeper structural issues like trade disruptions, automation, or demographic changes. Economists warn that while borrowing is easier, the underlying economy still faces challenges. On Wednesday, the Fed will announce its decision, marking the first rate cut in nearly a year. For some, it's relief. For others, a warning sign that the economy may be losing steam. As politics and economics collide, one thing is clear. The coming months will be closely watched by investors, businesses, and everyday Americans alike.